All right, hey everyone, this is Ben, and we are going to go over a Nike DCF today. And going quickly through our agenda, we have a situation overview plus comps, going to then go into the DCF, calculate diluted share count, and then weighted average cost of capital, major convention, and then price discussion. So I recently got a new computer and wanted to ask you guys in the chat if everything sounds okay with the mic. I adjusted my settings and everything, so hopefully things sound good. And there hopefully there will be no lag when I'm going through all of this today. So let's go over Nike situation overview first with the stock. And the reason I wanted to do a Nike DCF, besides just I always kind of do these DCFs on like tech companies, and so I think there's been some of you in the comments that wanted me to do things beyond just tech companies. And so I thought Nike would be an interesting one. Primarily first because there's a lot of issue with like tariffs and stuff like that. Also, when I kind of looked into the company, it seems pretty overvalued, but it's such a global iconic brand. And so I wanted to see kind of what the street thinks Nike kind of should be worth and how much more optimistic or conservative we might need to be to potentially invest in a company like Nike. And if you look at the stock, pretty much has been on a downward trend, which could signal that if things reverse, then there may be a lot of potential upside as well. So Nike just a few years ago was at like 177 and then has really been on a downward trend. So thought it'd be interesting to kind of take a look into this company. Please let me know in the chats if my audio sounds okay, because I just had to restart this stream to make sure that it does sound okay. The other thing I wanted to talk about in terms of the situation overview. Oh, it says 2 audio inputs. Your voice is coming in weird. Dang, I thought I fixed it. Let's see. All right. I do think that it might be. So is it much better or is it okay? Because it is possible that my settings are set so that my computer might be. Oh, okay. So Aiden says it doesn't sound bad. Yeah, I was concerned that maybe like my computer was recording the audio plus my mic, but it is weird, sounding like robotic. Dang. I wish I. Okay, it sounds like in the chat it's okay right now, so I'll just I'll check it. Well, for this stream, we'll just keep going, and then I'll check over the video, and then make adjustments next time. All right, so situation overview. There's the bull case versus bear case. So bull case, iconic brand, everyone knows Nike. A lot of strong staying power, especially if the company can keep going and reverse its current situation. Then there's a lot of potential upside. But of course, everything really always depends on the future, and that's really more important for any given company. Because you have companies like BlackBerry, where in the past they have like a lot of brand power and a great product, but then it'll just crumble eventually. Second, digital transformation of business models, improving margins, and personalizing marketing. There's been a huge shift at the company, as with most companies, to digitize a lot of their business model. And then appointment of Elliott Hill as CEO will result in strategic shifts, such as less discounting and focusing on core sports. So that's kind of a big part of the thesis. If you believe in Nike, then you hopefully also believe in their new CEO. And then bear case, Trump policy, volatility, and tariffs. Things have settled a little bit, but still with tariffs, I think still at around 30% for China, and then also I know Nike produces a lot in Vietnam as well. Just eats into their margins quite a bit. Next, intensifying competition with emerging brands like On and incumbents like Adidas. There's always competition, and at the end of the day, you have to remember that Nike sells a commodity, shoes, and a lot of what their business depends on is just their branding, which is pretty crazy if you think about it. And then innovation stagnation and operational missteps have led to inventory glut and markdowns leading to brand dilution. So it's the bear versus the bull case. And let's also take a look at comps. By the way, this entire Excel will be available to download as usual after the stream ends. So I put together some comps and I included some companies that are a little bit smaller, but still really well known, like Under Armour, Puma, Skechers. Like all of these companies, as you can see by market cap, are a tenth of or less of Nike size, which is it's about a $90 billion company. But I thought it'd still be a good point of comparison. So we have, I think what's most important as you look at this is you have Nike that decreased revenue growth or is expected to this year, barely grow next year, and then their margins are not fantastic, right? 9 to 10% EBITDA margins. Yet the company is trading at a premium to a lot of its competitors. So that makes me a little bit worried. It makes me think that Nike is probably going to be a little bit overvalued when we do the DCF. And just looking at comps, it doesn't seem like a bargain to invest to invest in a company like Nike based on the numbers here. That of course is unless we build a model and then we think that we have much more reason to be optimistic than what the street currently thinks or believes. So that's a quick overview of comps. And then before we get into the DCF, have to let you guys know about our sponsor for today's video, which is both, in a sense, Wall Street Prep and Wharton, which is where I got my MBA. So they have this applied value investing certificate program, and it's an 8-week long online course. The cohort right now will start in June 9th, but then they have this program every three times a year. And you basically learn about a lot of how a value investor would think about stocks or investing. And there's a lot of different speakers that you will learn from. Or sorry, first let's go into program curriculum. So you get an intro to what value investing is all about. If you're watching this video, you're probably interested in value investing, market efficiency, intrinsic value, which is basically what we're doing today, but there's a lot more to it. Institutional grade value investing. So there's the whole equity side of the markets, and then there's the bond side. Oh, sorry. Actually, this is not institutional grade. That made me think of bonds, but this is actually just more talking about how an institutional level professional invests. So that's part one, part two, and then growth, risk, uncertainty, process-driven value investing. So just a lot of really, really good information and things you'll learn from this program through the 8 weeks. And then as we go down here a little bit more, you can see you join a global network. You'll be in an invitation-only LinkedIn group, and then a lot of like cross-program networking events. And then the other cool thing that I think I may have scrolled through too quickly is that you'll learn from a lot of investors. I think they actually took it off the website for now, but previously in the past, they brought in Howard Marks, who is the CEO and founder of, actually, I don't know if he's CEO anymore, but he's the founder of Oaktree. And he's just kind of a legendary investor. I actually saw him at Wharton speaking at one of the events, and he has a really great podcast called The Memo, which I highly recommend as well. So now let's, before I go into the actual DCF, I have some questions that I think are some good ones in the chat, so I wanted to answer them. So, hey, just curious, DCF steps seem pretty much the same each time, just different numbers. So that is true. It's a pretty similar process and also similar in banking as well. I'd say, but not everyone who joins these streams have watched my previous ones, so that's why I kind of like start them from scratch, but then I do take from previous models to like kind of expedite the process. And some of the assumptions that I put in for each company obviously are different. So I think basically this is for the people who don't join every single stream, and then also just to kind of see how I make some adjustments for the revenue, and usually the EBIT assumptions are usually the most important ones. But I will say that yeah, I will say that the steps do tend to be fairly similar. And then yeah, Loren says, what happened to the mic? Can you guys let me know again? Sorry, I know I asked this before, but one more time. Is the mic okay, or is it really like echoey or something? Let's now go into the DCF, and I'm gonna open one of my other DCFs. See what a good one would be. We can hear you, but yeah, I guess I do have a bit of a robotic voice when I'm streaming. Sorry, I opened the wrong thing. Let's see, this one might work. Okay, so to save time, and you can also do this, of course, because if you go to any of my other streams, you can download any of the models for free anyway. So what I'm going to do here basically is just copy all TSV formulas, and then I'm just going to delete a bunch of this stuff. But we're just going to kind of use a similar kind of structure as always. This is fairly similar to what you do on the job as well. By the way, if you guys have any questions, I'll stop periodically and just kind of go through go in the chat and then answer some questions here and there as they come up. But let's take a look here. Okay, so 1231. All right, so as usual, I have the historical numbers here, and then we're just going to pull from them. So for 2018, go to sales here, just copy across. Revenue growth is your first year minus your previous year divided by, or current year minus divided by your previous year minus 1. EBIT, operating income, oh, I have a setting on that I don't like because this is a new computer. And typically a lot of bankers and people in general, I guess. So turn that on. Okay, after pressing enter, move selection. So that's, I think, the standard setting, but I like it when I press enter that I kind of just stay in the same cell. Okay. We have EBIT, taxes, tax rate, we'll have to calculate. Pretty standard tax rate. Okay, and then cash flow items. We're gonna have to do something a little bit different for the estimates, or wait, let's see. Oh, wait, no. Yeah, for DNA. Okay, so for our cash flow, you can see that the company has a May 31st fiscal year end. So then we're gonna have to do something called calendarization. So it's a very simple concept where all the numbers in the DCF here are as of December 31st, right? And so what we ideally want is for our cash flow items and everything to also be as of December 31st, but right now they're as of May. So there's this thing you do in banking where you calendarize to the year by just kind of having like an estimate in a sense. And we're going to do this up until 2024. So what we're doing, what this year really shows us is from May 31st, 2023 to May 31st, 2024, right? So if I were to write this down, 3/31/24 to 3/31/20, 23 to 3/31/24, right? So there's 3 months in 2024 that we have available. So actually, now that I think about it, I'm not going to have all of 2024 available. So we're actually going to need to download the previous quarters. This is going to be a little annoying actually. Cash flow items. I'm trying to look at quarterly. Oh, that's weird. That's Nike. Spam. I'm gonna see something. Usually there's like a quarterly option, but then yeah, I mean, it does report quarters, so it's weird. Let me just double check something. Cash flow, net income, 3008. Net income 3008. Okay, so I guess for whatever reason they call it YTD year to date. And what I'm going to do is download the quarterly filings. I guess I could actually, to be more accurate, download, instead of doing calendarization, which I'll still explain and go through, this I think will be more accurate. As this is loading, I see some questions. What takes up a lot of the time is building Mars models or the research. I would say actually the thing that takes the longest time is like going through the company operating model and then um, figuring out, making sure like everything in that model is working well. That probably takes longer than like anything else. Okay, so wait, this is actually still a pain because this is not for the full year. Damn. Oh, so this is 5. Oh, that's why I thought it was 3. Okay. Let's do this for 1 year. See if it's pretty repeatable, which it should be. But basically, this represents 3 months from November, December. No, wait, no. December, January, and February. 3 months. For 2024, we only want one of those months, right? So what we would basically do is 1 divided by 3 times the quarter that ends at the end of the year, essentially. And then you want to add the other 3, the other 2. So this represents 1 month, this 1/3. This represents 6 months. So 1 plus 7 is 8. Am I doing wait, 4 quarters in a year, 3 months each. 3, 6. Yeah. Okay. And then you add 1 more here. So that's 3, 6, 9, 10, and then 2/3 times this one here. So this would probably be the most accurate way to do it. But it's a little bit still an estimate, kind of annoying to calculate. Well, let's just do it for 3 years. So 2023, 2022, that plus 1. So just to explain this again, what I'm doing is I'm getting 1 month from this latest quarter, and it's not perfect because you are taking 1/3 of months that actually have happened in 2025. And then you're also adding the full 3 months for this second to last quarter, this quarter, this quarter. So 3, 6, 9 months plus the 1 month here is 10 months. 1 month here is 10 months. And then you're taking the 2/3 of this number here from this quarter because that gives you basically 2 months. So this all ultimately is like a estimate for 2024. And we're going to do that exact same thing, but for 2023. So it's probably easier if okay, so move this down to here. No, I shouldn't be using my mouse, but whatever. Okay, so 2023. Oh, okay, I guess that messes everything up. This should be actually over here. So you're taking 1/3 of that full, and then full quarter, full quarter, full quarter, 2/3 of this. Then for this one, going to take, why things get kind of confusing. Oops. That, move this here. All right. Now we have 20, basically we have 3 years worth of data. And then if we copy paste this down, we have all of the financial metrics needed from the cash flow statement. So now I'm going to move this to our DCF. And then rename this to quarterly. All right. So the reason I did that is because I wanted to figure out our cash flow items. And normally when we don't have to do all this calendarization stuff, which I just did, it's easy to just pull it, but and have like multiple years. But I think for this one, we'll just go with 3 years because I don't want to do all that work again for just like a few extra years. So we have depreciation here, amortization. So we have these separate. We're going to have to add them together. Usually DNA is actually in just one thing, but one line, but I guess they separate it for some reason. So you get that plus this amortization here. Then okay, and then CapEx. Purchases, let's see, investing, purchase of short-term investments, investment additions to plant property and equipment. Looks right. But I like to make this, all my numbers in my model positive. This is kind of weird though. DNA. Okay, so this is something separate that I pulled. And it's, I don't know why these numbers aren't really tying. So CapEx, let's take a look. So in FactSet, you can always go and see how the numbers are being pulled. This is additions to plant property and equipment. Let's look at the annual. Additions to plant property equipment. Yeah, so these, oh, did I just pull the wrong number? Oh, wait, no, I didn't. Oh, this is quarterly, okay. Oh, there's something weird going on. Oh, dang it. So the process of what I did is correct. No. Basically, something's weird here because these CapEx figures are like 2,000, but then they actually should be somewhere around 1,000. So I think the numbers I pulled are probably not. That's why actually this is weird that it says year to date instead of quarterly. Sounds like it's not very trustworthy. All right. So what I'm gonna do is take a bit of a shortcut. So kind of not, I'm going to basically use fiscal year here, which is 531. And we're not going to use the exact numbers. We're going to use the percentages because they should still be roughly accurate anyway. So I guess like it is still relevant if you like want to go into banking or just want to learn about what we just did with calendarization. Still very important. But for the purposes of this model, I'm going to just save some time and then go into the use our fiscal year figures instead of our quarterly ones that we calculated. Okay, so what the heck? Oops. Yeah, Donnie, I agree. I think that is what it's saying. So anyway, we're gonna forget about it and then just do it this way. So we have our DNA, we have our CapEx, over here, so starting from 2018. And then change in net working capital here. And then we can now calculate our percentage of sales. So I'll kind of explain what we're going to be doing. I anchored this cell here with the row in order to just copy paste this here. And as you can see, when I check, they're all dividing by our current revenue. We can also check as a percent, as our change in sales. See which one's like more consistent and one we can kind of use. But clearly, the percent of sales is more consistent over time versus our change in sales. So then let's see. Basically, or one thing I want to explain here is that previously I was trying to get to like the most accurate number possible by doing all that calendarization and then trying to get our percentages that way. But then I think given that we have pretty consistent numbers just looking at our fiscal year end of May 31st with for DNA and CapEx, I think it's okay to kind of just use these numbers instead of trying to calculate, trying to calendarize and do all that stuff we were doing earlier. So, all right, now let's actually build out the DCF. And given that the company is pretty steady in terms of growth, actually expected to decline this year, most likely due to tariffs and lack of sales. Yeah, that's also going to eat into their margin, but analysts over time are kind of predicting that the company will be able to grow again over time, though I don't think that these numbers are really reliable. As a reminder, this is a street-based DCF, an analysis that we would do at JP Morgan all the time. It doesn't really involve that much like primary research because we're essentially just looking at what Wall Street estimates believe. And equity research analysts, like they do a lot of primary research. They talk to managers, or they talk to executive teams. They do their own research about like the industry, and then they come up with their own models for how much they believe a company can grow or how much the margins will increase or decrease over time. And then sounds like there's an echo. Maybe my mic is just not plugged in correctly. One sec. All right, hopefully this is better. Let me know what you guys, let me know in the chat, please, if the mic sounds any better. Mm. Dang, I don't know what the issue is because everything from my end. Oh, maybe this will help. Does this sound better? Test, audio test. No, okay. I'm getting that it does sound the same still. Damn, this is weird. Test, audio test. Audio test, is this any better? And you guys in the chat, let me know if this sounds better. I changed some of my settings. Okay, but you guys are getting like some kind of echo. That's so weird. Let me Google this. Echoing OBS. All right, sorry guys, but I'm gonna try to fix this. So go to settings menu, then audio. Desktop audio. Okay, I disabled one thing. Let me know if it helped. Test audio. Okay, no. Oh, it's good now? Oh, dang. Okay. Glad that worked. Okay. So yeah, if you guys just joined, I purchased a new computer. One of you guys asked, so I bought like an Alienware gaming computer actually. I don't play any games anymore. I used to in high school, but um it it was just like had really good specs and whatever. So it's much better from my end. Like it's you guys kind of said that it didn't really lag that much, but for me, the lag was unbearably bad. So I just bought a new computer. Okay, so anyway, let's now go into the DCF, and I'm gonna kind of try to speed through this a little bit because I do have to go to the airport in a bit to pick someone up. So we have our growth rate here. And now let's do some thinking as to what we should do for our revenue. So we're just going to really sensitize our revenue and EBIT, and then that'll be it. Pretty simple stuff. And okay, so I think the first 2 years, 2025 and 2026, we can believe to be true. 2027 to 28, probably we're going to have to come up with our own. And for 2025, we basically have 6 months, 7 months left of the year. So the 2026 numbers should be fairly accurate. So for 2025, 2026, given that this is a street-based model, we'll just kind of go with the numbers here. But then for 2027 onwards to 2029, the street seems to think around 9% to 7%. But again, if we look at tax set and we look at estimates, let's see how much things drop off in like 2029. Yeah, there's like barely anyone. 2028, barely anyone. 2027, good number. Basically 2026. Okay. So 2025 and 2026, fairly reasonable. Like a lot of people are a lot of equity research analysts are there. 2027, 2028, not very reliable. So we all kind of have to think about like what we believe. So -6%, largely probably due to just Nike like like new CEO. They're kind of like re-strategizing. I'm sure there's a lot of reasons why this growth rate in 2025 is -6%. But then we kind of see like a slight rebound in 2026, and then based on historicals, first of all, we don't ever want to go up over like 10%. And then typically for large companies, you actually see revenue decelerate over time as opposed to increase because your revenues are getting larger and larger. And then, so I'd say that even in like a slightly optimistic scenario, we would want this to grow up to somewhere like 6%. Um, and that's a little bit based off of the numbers here where you kind of like, although these aren't super reliable, they do provide some kind of guidance. Um, but just to be conservative, I'm just gonna say we're gonna grow up to like 5%. Um, and that's kind of actually, yeah. I'm gonna do something that I normally don't do actually, which is, hmm, thinking here. What I basically want to do is actually just kind of grow this up to 5% and then grow it down to 3%. It sounds really simple, but based on what has been happening with Nike, I kind of think what makes sense is the company to rebound up till 2027, increase its growth rate, and then over the next few years kind of decelerate. And I think that does kind of make sense based on what's happening with the company. So let's just right here 2027, and then revenue 2029. So let's say it grows to 5%, then decreases down to 3%. Honestly, yeah, these are extremely simplifying assumptions in a sense, but um, I think it makes I think it makes sense in terms of with the numbers we have so far. And for here, we're just, okay, since this is so simple, I'm just gonna, normally I don't do this in hard code, but I'm just gonna hard code this one, save some time. Get blue. Okay. And then for our conservative case, I think we can just make this kind of just believe 2025. I think that's fair. 2026 and then onwards, we'll just want to make a little bit less than what we're projecting. So let's call it 90%. And then for optimistic case, make it under 10%. And I might change this, but I just want to see what it looks like right now. Yeah, so the numbers look kind of like they're the same, but if you look at the decimal point, I'll just add the decimal point just so you guys can see. Um, you can see that everything is a little bit different. I'm just gonna add a note here. Are coded for simplicity. So these are the revenue figures. Let me just kind of take a look here. So again, what we're assuming is 2025, not much different than what the street thinks. Although, yeah. And then conservative case, or in the base case, we're assuming they grow up to 5%. Kind of like is implicitly a little bit bullish on Nike, assuming that they can do that. But if the company is growing at 5%, 4%, 3%, honestly, it's not even really that much. Um, and we're kind of basing this 5% off of what some of the brokers do believe, which is that the company can grow 9% in 2027. So inherently a little bit conservative from that perspective. I do think that our conservative case, we can go down a little bit more. And then same with our optimistic case. And let's see what that brings. So 2.2%, 4%, 3.2, 2.4. I think this is like a good range. So we'll do that. Offset, use our offset formula. Revenue, anchor it. Oops. Reference this cell, then go to our switch. So then, oh, interesting. The company is expecting 2 years of negative 6% growth. So hopefully, yeah, the whole company really needs to rebound. Next, EBIT, we'll do a similar thing. All right, so now we have to kind of take a look at the company's EBIT and what is happening. So right now, the street thinks the EBIT margin will decrease to 7%, which probably makes sense because of all the tariffs. And then because there's so much uncertainty, I'm sure a lot of the equity research analysts kind of built that into 2026. Like Trump's not going to stay in office. He's going to be in office the next 4 years, right? So then um, you can imagine that Nike will do its best to combat the tariffs in some way and move production or do whatever they can to not pay as much as possible. But for now, better to be a little bit conservative. Um, so I kind of do feel like these numbers make sense. Like it seems like Nike in its heyday was generating 15% profit margins or EBIT margins, and then um, this upcoming year of 2025, 7% probably going to be pretty accurate. 8%, I think not too crazy. So we're gonna use this 7% and 8% here. And then maybe just grow up to a certain so EBIT in 2029. So I think growing it to 12% actually is pretty fair. So let's do that. So what I'm going to do is get our previous year plus that minus that, divide this by our number of years. So we're growing it up to around 12%. I feel like that's pretty fair. And then for our conservative case, an optimistic case, again, we're just gonna go with go with 2025, and then for 2026, 2020 to 2029, we'll have the percentage. And for EBIT, for margins, usually there's not as much variance as opposed to revenue growth rates, which can kind of be a lot more volatile. So let's take a little bit less off of the margins for our conservative and optimistic cases. So 7% to 10, basically like 11%, and then 7% to around 13%. I feel like this is pretty conservative for the most part. And since a lot, let's see, so up, down, yeah, 13%. Given that there's a lot of instability right now with tariffs and what Trump is going to actually do, I think better to be a little bit conservative. And if I had to guess, though, I would probably go a little bit more with this optimistic side versus like, I don't think their margins are going to, like the company's margins are going to be this low for too long. So 11, 12, 13%. I'd probably go a little bit more with this optimistic case, basically. Right? So that was pretty much the bulk of it. Now we'll just calculate the other things. So taxes, have the rates. We're just going to take an average past 3 years, be fair. Taxes, EBIT times our tax rate, EBIT, EBIT minus taxes, DNA, here, divided by our sales, CapEx, similar thing. Then change in net working capital, same thing. Okay, then just going to do the same thing as what we did for our taxes. We're just going to get our averages here because everything is so consistent that you can just rely on historicals. And now we can calculate our unlevered free cash flow. EBIT plus DNA minus CapEx minus change in net working capital. And then now we need to get our WACC. So we have our projected free cash flow, but we need our discount rate. So let's get our market cap of the company. $88 billion. 88589 basically. 88589. Risk-free rate is our 10-year treasury yield. 4.509%. Company's beta 0.71. Oh, surprisingly very low, actually. Actually, maybe that shouldn't be that surprising. Market risk premium. Go to New York professor who always posts these. Okay, 4.41%. Then debt. Let's see if Nike has any debt. We'll go to the balance sheet. And then, yep, current portion of long-term debt, accounts payable. Okay, so let's calculate the amount of debt first. So current portion of long-term debt, 1,000. Plus notes payable of 4 million, barely anything. Then long-term debt of 7,756. And that's it. So not too much debt. Seems like they have about 8.9 billion. And then cost of debt. So I'm gonna have to try to dig for this. Doesn't look like it's. So we're probably gonna have to go to the 10K to see what. I wonder if AI can tell us Nike interest rate. GPT. Wait, 2.5%. All right, let's just go to the 10K. All right, here we go. So interest rates of around 2.4% to 3.38%. And looks like it's all pretty similar amounts. So the midpoint of that is pretty much around 3%. I know it's very much an estimate, but I think it's fine. Make that estimate. Tax rate, we're just going to go with this 15% here. The WACC of 7.21%. That's fairly low, but I do think that makes sense because the company's beta's 0.71. And it is a very, very established company. So actually, I think this is pretty good. So let's get our WACC in here. So for our base case, we can just use the WACC that we calculated. Conservative case, add 0.5%, and then our optimistic case, anything lower than this is honestly like way too low. I would never use a WACC like 6.7% for Nike. Then we can use our choose function. Do the same thing for our terminal growth rate. Standard is 2.5%. And so now we look at our agenda. We've done our WACC. I guess we kind of skipped a step a little bit, but we have to calculate our diluted share count and then calculate our WACC, do mid-year convention. Then we're pretty much done. So shares, there's basic shares and there's diluted shares. And diluted shares is a more accurate representation of your company's. It gives you a more accurate share price, implied share price. So let's calculate the company's diluted share count. So we have class A and B. Add these together basically to get our total number of basic shares. So a lot of shares there. And then then we basically just need to look at stock options and then any like other types of dilutive securities that they have. So here we can see stock options. No, we need. So as I've been doing this, I see a lot of questions about, is this Excel going to be uploaded? Yes. Right after the this video is done. Like obviously I can't upload it while I'm working on it. So afterwards there will be a link for you to download this Excel for free. And then this video will be able to be watched. Will be published. Right now, I'm just trying to look for the number of stock options that they have and the weighted or the exercise price, but it may not be in the 10Q. Yeah, I guess we'll have to go into the 10K. Oops. So for whatever reason, a lot of times companies don't have the information in their 10Qs, and so just need to go into their 10K. Here we go. So we have a stock options. We have the options outstanding number, which is what we're looking for in the option size price. So 73.7 million. These are the number of stock options, and then the average exercise price is 98.1. So actually, they're out of the money. So it won't even add to our dilutive share count. And this is because the current share price has fallen so much that most of the stock options that employees and whoever at Nike have are actually they're actually pretty useless or worthless, which sucks for a lot of Nike employees. Also, I realize we want this in millions, so I'm going to divide this by million. And then let's see about the restricted stock units. So there's 9.1 million. And it seems that may be it. So basically, there's just 9.1 million more shares to get our diluted share count. Um, see a question about, shouldn't the option value of the options be calculated though they're out of the money? Because they're out of the money, they're they don't add to the share count at all. So if this was like 5, then it would add to the share count. But given that it's above the current price, the options are worthless. You assume no one would exercise them, so you don't add that to your dilutive share count. Okay, so with that said, now what we can do is we're almost there. Basically, now we just need to calculate do the mid-year convention, and basically get our discount periods, and then we'll discount everything to get to our present value for our levered free cash flow and our terminal value. So for discount period, right now we have Nike. Today's date is the 26th, 25th of 2025. And then what we need to do is, if you've followed these streams before, then you know what we're going to do here. But just to kind of explain for those who haven't, 2025, when you do a DCF, you only want to look into the future. So 5 months of 2025 have already happened. So we don't want to take any of cash flows that have happened already. We only want the future. So we want the remaining seven-ish months of 2025. That's what we want to use for the DCF. So, and that's where we're going to calculate. We're going to use the year frac formula. Starting with our current date and then ending with our year end. So as I mentioned, there's 7 months left, a little bit more, but about 7 months left in 2025. And this 0.6 basically is saying we have 0.6 months left in the year. And then for our actual discounting for the free cash flows, what we used to do at JP Morgan and what banks typically do is they don't assume that you get all your cash at the end of the year, because then you are discounting kind of a little bit too much. It's a little unfair since you're actually receiving cash every day of the year. But you just make a simplifying assumption that you get it in the middle of the year. So we're assuming that we get cash. We're going to discount back by 0.3 years instead of 0.6 years. So this gets us to the middle of what we have today until the end of, we get in the middle of today's date to the end of 2025. And then for the remaining years, we want to get to June 31st or June 30th, 2026, June 30th, 2027, etc. So what we would do here, we have 0.6 years left this year, right? So this gets us to the end of 2025. Then we just need to add plus 5, 0.5, I mean, because 0.5 years is 6 months. That gets us to June 30th, 2026. And then from here, we just add 1, because you're just adding a year more. That's our discount period. So now what we can do is calculate our present value of everything. So our present value, going to do it to the power of our discount period. Everything looks good there. Terminal value, we're going to use our perpetuity growth method, which is our last year's free cash flow times 1 plus your terminal growth rate. All divided by your WACC minus your terminal growth rate. Then present value, divide that by 1 plus your WACC again to the power of your last year's time period. And then we can calculate our enterprise value, sum of our free cash flow, and then our terminal value, 85 billion. It's actually a lot higher than I expected. Cash, we need to calculate. You're out. Oops. Let's go to our balance sheet and then current assets and short-term investments, 8.6 billion plus 1.792 or 1792. So we have 10 billion in cash that we calculated for our WACC. We can just pull from here. Have about 9 billion. And then equity value is our enterprise value plus our cash minus our debt. Share count we can get from our share calculation here. And then equity value divided by our share price. $58.41. So current share price is $60.02. Implied share price that we have right now is $58.41. So implied downside right now is 3%, which actually isn't really that bad. I think a lot of this is being driven by how low our WACC is at 7.2%. And for instance, right now everything's in the conservative case because 1 is conservative, 2 we put here as optimistic or base street case, and then 3 as optimistic. Right now, yeah, in our base case we have 30% upside, and then in our optimistic case, purely optimistic, we have 82%. But I would never ever use this 6.7% WACC. I think to be conservative, this is like probably what I think is more accurate is the 3, 5, 4, 3, 7 to 12%. Maybe like one of these being a little bit, let's see. So one conservative here. So I'd say this is my kind of like low end. It is this 63. And then a little bit more on my high end. Right? Is this 30%? I guess it is. My absolute high end, I would imagine that their margins are going to increase to 13%, which is achievable. The company has done it in the past, right? Revenue growth, I think I'm okay with keeping it from 2.7 to 5 to 3%. So at the high end, we have 85.13. Which, typically whenever I do these models, because it's for tech companies, we always get to like this crazy number where it's like, oh, the company is so overpriced. But actually, I'm very surprised as well. But it looks like our Nike is undervalued from a DCF perspective. Like, I don't think we were actually overly optimistic with any of our numbers here. We have negative 6% in 2025, and then the company's growing by a few percentage points. Like, you could argue, sure, maybe things should be like smaller, or like the growth rate should be lower here, but we're just basing it off of street estimates, right? And being more conservative than some of the figures that we have here. And after the company has dropped in by like 10% over the past 2 years, we're assuming that they're able to kind of refocus and grow the company in the next few years, right? So I think that like kind of roughly makes sense for margins, hit hard by tariffs, but over time, company can hopefully just get back to where they were historically. And then tax rate, that shouldn't really change much. D&A, CapEx pretty much cancel each other out because they're both at around 2%. And then change in net working capital is around 1%. So yeah, I don't think that too much of this model is like off by any means. Trying to see if I like made some kind of mistake somewhere, but I don't think so. Yep. So yeah, surprisingly, I guess maybe if we look at Nike's stock price, company has been hit hard for a really long time. So if you do believe that the company is able to refocus and re-strategize and grow the company, then there's a lot of potential upside, especially if the whole tariff issue resolves itself and the company has a better path towards higher margins. So Nike looks like it could be an undervalued stock that, as long as they make the right decisions, can gain a lot in terms of like stock, in terms of value. Um, but if the company continues to, not grow, we look at comps here, you do see that there are companies that have really been punished stock wise, or maybe they were never that big, but like Puma, Under Armour, these are like big household names, but they're nowhere near as like large as Nike. Even Adidas is half the size of Nike. So pretty interesting. Yeah, let me know what you guys thought in the comments. I probably would also just do a lot more research into what Nike's strategy is and if we think that the company will actually be able to implement their new strategies. Um, but yeah, interesting results here, in my opinion. Let me know if you guys have any more questions. I will see the chat. Doesn't seem like there's too many more questions. So yeah, that's pretty much it. Hope you guys enjoyed. Let me know in the comments if you guys want me to look into any other companies or anything like that. And yeah, catch you guys in the next one.